The price to earnings ratio is the golden ratio of stock investing, one of the most important financial metrics that exists. If you're an active investor picking individual successful stocks for your portfolio, you want to understand the price to earnings ratio, or the PE ratio. And that's what we're here for. In this video, you'll learn how investors can use the PE ratio to compare the valuation of two or more companies. Wednesday Wisdom Nuggets brought to you by... Stock trading could be your other income stream. Open a trading account through the AIB DigiTrader app, online platform, or USSD and lay the foundation for a different 2021. As an investor, you want maximum value at the lowest cost. Company A's stock is trading for 60 shillings, while Company B is trading for 10 shillings. Both companies are in the same sector and business, and as an investor, it may appear to be a bargain to buy the cheaper 10 shilling stocks. But how do I know this is the better choice than the relatively more expensive 60 shilling stock? The PE ratio can quickly help clear things up for you. In the stock market, a low share price is not necessarily a bargain. It is only a bargain if it is low in comparison to the profits the company in question earns. Back to our example. Company A has been around for a long time and has established itself selling technological products door to door. The company makes 100 million shillings a year in profit, minus the dividends they pay out every year. Company B, a relatively newer competitor, sells the same technological products on their new online platform and makes 10 million shillings a year in profit, minus the dividends they pay out. Company A clearly has higher earnings, but with a stock price of 60 shillings, we still can't tell if this is the better bargain overall. Our first step is to calculate the earnings of the two companies per share. This is calculated by simply dividing the company earnings by the number of shares each company has issued. Company A has 50 million outstanding shares, while Company B has 1 million outstanding shares. If we divide the amount of earnings by the number of outstanding shares, we find that Company A, with 100 million shillings profit and 50 million outstanding shares, has an earnings per share of 2 shillings. This means that each share owned by an investor has a claim of 2 shillings, what we call its earnings per share, or EPS. When we do the same calculation with Company B and divide its 10 million shilling profit per year with its 1 million outstanding shares, we find that it has a 10 shilling earnings per share. At a glance, we can now compare the company's profitability. As stated, the earnings per share indicates how much money a company makes per stock. We can note that although Company A reported a higher profit, Company B has a higher earnings per share. However, it's not enough to stop at the EPS. Now that we have the EPS of the two companies, we can calculate the PE ratio. To calculate the PE ratio, we divide the company's share price by its EPS. Company A's PE ratio is therefore 60 shillings divided by an EPS of 2, which is 30. This means the stock is trading at 30 times its earnings per share. Company B's PE ratio is its stock price of 10 shillings divided by an EPS of 10, which is 1, meaning it's trading at a 1-to-1 with its earnings per share. In this example, Company B, although it has the lower earnings, may be the better bargain. This time, not just based on its lower stock price, but because it has a lower PE ratio of 1 compared to Company A's PE ratio of 30. This is because the lower the PE, the less an investor is paying per shilling of a company's profits. Although this ratio, as you can see, is very useful, investors should not stop here. Other aspects of a company must be taken into account. Subscribe to never miss an opportunity to grow as an investor. See you next time.